My name is Nick McGrew from Polymath Legal. At Polymath Legal, we help real estate investors generate generational wealth while keeping the SEC away. So what that means is we help you raise the capital for those big deals you're trying to acquire and make sure that you do it in a lawful way so that you can focus on your deal and not have to worry about SEC or laws or all that fun, boring kind of stuff.
Yes, it's fun. There are other words I would use to describe this, but I'll let you have
exhilarating.
fun.
That's another
Yeah,
one.
exhilarating was the one. Okay, so first and foremost, I want to start with how do I know if I even need, how do I even know if I need a securities attorney? And there's a fancy whiteboard if you need to write things down.
Okay.
I forgot about it, so I didn't use it.
All right, cool. So the simplest, it's not a simple thing, but I will try to simplify it as much as I can. So if you have a passive investor, there's a very good chance that you are selling a security, in which case that means that you either need to register that security, like a public offering, or you need to find an exemption. And so when we're looking at real estate timelines, going through a public offering, you're not gonna have the time to take down a deal and also get registered. And so with my clients, we're looking for exemptions. So we're trying to figure out, okay, what are your goals? What are you trying to achieve? Who are you trying to raise money from? How much? And then what exemptions might work for you? And then after that, we're gonna figure out which is gonna be the best one for you to achieve those goals. So if you're having passive investors, at the very least, you need to talk to a securities attorney to either see, am I raising a security? And if so, then you wanna make sure you have an exemption for that.
Okay, so at the thought of taking someone else's money into a deal that is not going to be active in the deal, that is when you call a securities attorney. Okay, are we all clear on this? Yes? Yes. I can't even hear anybody.
Let's hear it, yes, huh? All right.
Okay, so that's first. Second, let's talk about the Howey Test. Okay, so there's something called a Howey Test. When you are selling a security, or to determine if you're selling a security, there's a Howey Test. There are 4 parts to it. Tell us what the parts are.
Yes, number 1.
Let me write it down.
If there is an investment of money. So as I said before, if you're selling a security, you have to register or have an exemption. So the Howey Test, I simplified it for you and said if you have a passive investor, there's a good chance you're selling a security. The Howey Test is what we really use to determine that. So number 1 is, do we have an investment of money? So that's number 1.
I'm so bad at writing on this.
That works.
Okay, yeah.
So 1 is an investment of money. Number 2 is into a common enterprise. So if there's an investment of money into a common enterprise. So if we're pooling this capital together and using it to buy an asset together, where we've got ourselves a common enterprise most likely there. So an investment of money into a common enterprise. Number 3 is with an expectation of profit. I'll let you write that down.
I know, I'm slow because this is hard to write on. I can buy a $100 million deal. I cannot write on this iPad though.
So again, as we're going through this, think about your investors, the people your private money lenders, the people that you're gonna be getting this capital from. They're investing money. You're probably gonna have multiple of them, so you're pulling that money together so we have our common enterprise. How many of your investors do you think are expecting a profit? Probably all of them, right? So if they're expecting a profit, that's number 3. And then number 4 is that profit expectation is coming primarily from the work of someone else. And so that's why I led with if you have a passive investor. So your investors that are writing checks that say, hey, we love that deal, go ahead and take down that asset, here's my check, I'm expecting you to give me a check quarterly or monthly, and then at the end I want a big check when you sell, they're likely gonna fit this 4-prong test. And so again, if we have an investment of money into a common enterprise with an expectation of profit, primarily from the work of someone else, then that means you're selling a security, so you've got to register that or have an exemption. And that's the general rule. Now, with law, there's always exceptions and nuances and things like that. But that's why I said, if you have a passive investor, there's a very good chance that you're falling into this realm here. And so at the very least, you need to make sure you talk with somebody to see, do I fall into that? If not, good. If you do, then make sure you're finding an exemption.
I came up with ICEs as the mnemonic to remember this.
There you go. Whatever makes you remember,
Yeah.
I love it.
ICEs.
I think are we doing Q&A?
Yeah, we will.
Okay.
Oh, did someone have a question right now?
I think I saw hands.
All right, let's
I think
jump right in.
I saw back here first.
All right. Oh wait, hold on. There's like a box. Oh, this is a lot of
Love it.
pressure.
Toss it. See, I told you we'll liven it up here. The law doesn't always have to be boring.
Can you hear me?
Yes.
Okay, if you have one investor that wants to invest into your project, do you need to do this?
Good question. So at the very least, you need to go through this evaluation. Now, do you need to do it? Potentially not. So a couple ways where you might not need to. One general exemption is that if you have a promissory note and it's for a single family and it's on title, so they have a lien position, then in most cases that's not going to be considered security, in which case you'd be fine. Another scenario where you have one investor and you can take yourself out of this realm is make that investor a true partner, make them be active, give them some decision-making rights. And I know sometimes you don't want to do that, but nonetheless, if they do have decision-making rights, if they are running this or managing it with you in some form, then they're not expecting a profit primarily from the work of someone else. They're expecting it maybe from somebody else's work coupled with their own. And so that's also probably going to take you out of this as well.
Basically, every answer that he's going to give you is going to start with "it depends," or he'll sometimes change it up and be like "probably" or "possibly." So
because there's nuance, it changes. I don't want you to say, "Well, Nick told me this," and we know how fickle the law can be. So one small change or a comma can dramatically change stuff. So I'm giving you guys generalities of what we usually see, but again, there's a lot of nuance, and so you want to make sure you have somebody looking at your unique situation.
okay.
I think there was a hand back
I was
there
gonna
first.
ask.
Oh,
Okay.
I was gonna ask just a couple examples of what exemptions are. That's all.
Yep.
Ooh, we getting into it. Oh, we could talk all day on that stuff.
Okay.
So I'll talk about one exemption that I think works pretty well for real estate and what I use for a lot of my clients. It's called Regulation D, D as in dog. And within that, there's multiple subparts, but the two big ones that are often used is 506B, B as in boy, and 506C as in cat. And so before we even dive into this, we first want to understand the concept of accredited investor and sophisticated investor. So an accredited investor, if we just want to have a way for you to wrap your head around it, you say somebody who either makes a lot of money or has a high net worth. Now, a more specific way that people show that they're accredited, typically they show based upon their income or their net worth. And so if we're talking about an individual can show that they're accredited if they've made $200,000 or more the past 2 years and expect to make that much or more this year. So $200,000 income for an individual, or if we're talking about spouses, then it's $300,000 between the two of them. So $200,000 for an individual or $300,000 for spouses. If you make that much and you've made that much the last 2 years and anticipate going that much again, then you're accredited. Another way you can show that you're accredited is through your net worth. And there we say you're accredited if your net worth is $1 million, excluding your primary residence. So most people that are not in the real estate game like we are, their primary residence is probably going to be one of their biggest assets. So we take that out. And if we say, taking your home out, are you still worth $1 million? If the answer is yes, then you're accredited. So for accredited investors, we're thinking 200 grand in income or $1 million net worth. Following along so far? Yeah. All right, so then the other type of investor we want to understand is what's called a sophisticated investor. This is an investor who's not accredited, but based upon their work or their education, or maybe their current investments, or working with a financial advisor. Basically, we're looking, do they possess the resources to determine the risks and merits of this deal? Can they figure out, does this deal make sense for me? Does it make sense for my risk tolerance, for my financial position, that sort of thing? And so that's how we determine whether somebody is sophisticated. And if you're thinking, I don't really know, I'm not so clear, whereas accredited was very clear, you're correct. That's one of those kind of areas where they give us a little bit of guidance, but not clear, hard and fast rules. But again, at the end of the day, if we're trying to figure out if they're sophisticated, we're saying, can they vet this deal? Can they see, does this make sense for them? You know, if it's somebody who Again, throwing no shade at all, but they have a W-2 job that's not in the financial space or the real estate space, and they maybe have a 401k or a few stocks and haven't done any types of alternative investments, they might not be sophisticated. Whereas if you have somebody who maybe still has that same W-2 job, but they know Avena, or they have a cousin who does flips or does small multi-units, and they've invested in some of those, that experience might be enough to say, okay, they're sophisticated, they know this world, they know how it works, so they can kind of fend for themselves and figure out if this makes sense. So accredited is makes 200 grand or more, or worth 1 million or more. Sophisticated is I have the experience, knowledge, or help to determine, does this make sense for me? Following along? Good, good, good? Okay, so now that we've got that, this is a long answer to his question, what's one example? So now that we've got that, with 506C, this one you can have only accredited investors. So all your investors in a 506C deal must have that $200,000 income or that $1 million net worth. But one cool thing you can do with a 506C is that you can advertise your deal. So if maybe you have a couple of friends that are accredited and they've got some friends that are accredited, all of those people can invest. And you can go on social media. There's some rules about marketing and stuff like that, but nonetheless, you can go on social media and talk about how you have this great deal and this great opportunity. Again, we're only allowed to take money, though, from accredited investors if we're dealing with 506C. Now, we contrast that with 506B. 506B allows you to have accredited investors. In addition to that, you can have up to 35 sophisticated investors. So that means that not everybody in your deal in a 506B has to be accredited. 35 of them can be those sophisticated investors we talked about, to where they can vet the deal and see does it make sense for them. Now you might say, okay, well then why would I do a 506C over B? Because I can have accredited and unaccredited. Well, the reason why you do that is because with a 506B, all of your investors, you must have a pre-existing substantial relationship with all your investors. Meaning you've got to know them before the deal's on the table, and you essentially need to know whether they're accredited or sophisticated and the reasons why. And so with a 506B, you're not able to cast your net quite as wide, because you can only sell this to your network and kind of your closer network. Because again, it can't be just, I know them. It's got to be, I know them and I have a pretty good idea what their financial situation is. So you're trading between 506B and C. C allows you to advertise, but only 100% accredited investors. Whereas B, no advertising, but you can get up to 35 investors that are not accredited. And that's just one of many, many, many exemptions that you have, and kind of the analysis and calculations we do when we're trying to figure out what's going to make sense for you in your deal. So I know that's a very long answer, but hopefully that was helpful. And I didn't say it depends as well.
Saying it depends, because that's usually what he would have said.